Welcome to the channel. This is Sebastien Boyer, the approved guy. Thank you for watching. On today's video, I'm going to be sharing with you some of the different debt elimination strategies that you can consider depending on where you are on your journey, your level of commitment, your discipline, as well as how well you know yourself and your ability to handle debt. Now, some of us have no business managing any debt at all. We should be cutting up our credit cards and we should not have any debt because we're credit holics. Just like an alcoholic should not have one drink, a credit holic should not have one credit card. You should cut it up and stay away from it because you don't have the discipline to use it and leverage that credit. You abuse it and it becomes bad debt. If that's you, just be honest with yourself. Know yourself. And for you, you should be using a compounding cash flow debt elimination strategy. This is otherwise known as, or popularly known as, debt snowball. I don't call it debt snowball because that's what Dave Ramsey calls it. I'm not Dave Ramsey. I'm Sebastien Boyer, and I call it your compounding cash flow debt elimination strategy because technically that's what it is. Your cash flow goes to pay off one debt. Once you've paid off that particular debt, you then take the cash flow that's now available, which is the minimum payment you would have been making on that first debt. And instead of using and spending that money frivolously, you reallocate it. So you compound that cash flow to the next debt. So you're compounding your cash flow from one debt to the next debt to the next debt. It's a compound cash flow debt elimination strategy. Now, the order of paying off your debt can vary. That can be what that snowball says is pay off the lowest balance first. Then there's also debt avalanche that says pay off the highest interest rate first. Then there's the cash flow index, which basically says if you were paying the bare minimum payment, pay off the one that has the minimum amount of remaining payments. That's going to have the lowest cash flow index score. And therefore you pay off the one that has the lowest remaining amount of payments if you were only paying the minimum payment. Sometimes that lines up with snowballing, which is paying off the lowest balance. Sometimes it does not. Sometimes cash flow index puts it in a different order. But that typically, in my experience, is going to be the most efficient and effective way if you're really trying to be very careful and effective to pay off your debt as quickly as possible. So the order does matter, but it doesn't matter too much because at the end of the day, as long as you are compounding your cash flow to pay off the next debt, you are going to be doing better than if you were just paying minimum payments, or even if you were paying a little bit more on top. And then once those funds became available from that debt balance, from that minimum payment, instead of using it frivolously, no matter what, you're going to do better. Okay. But if you're someone who cannot manage or handle having available credit because you don't use that wisely and it becomes bad debt, you use it for stuff you can't afford, entertainment, travel, buying clothes, and, just enjoying yourself, which is all nice and well. But that's bad debt. There's no return on investment. You're not using it to build wealth. It's simply just giving you, satisfying a desire or a need that you have to spend money that you don't have. Well, that's bad debt. And if that's you, this is where you need to stay. Stay in this environment of compound cash flow debt elimination. That's where you should stay. Now, another order could also be, just paying it off based on your own emotions. Maybe you have a debt on your credit, which belonged to an ex-girlfriend or boyfriend or an ex-spouse, and you don't want that. So even though it's not necessarily the most efficient order to pay it off, you just need to get that off your credit. And so you're going to prioritize that. Listen, there's no judgment in doing that. If that's what you need to do to stay focused on your goals to pay off debt and become debt-free, then focus on that one. Okay. So there's no right or wrong way. There's just going to be maybe a more efficient way. But at the end of the day, any action you take towards eliminating debt and becoming a better steward of your money is something better than doing nothing. So the worst thing you could do is nothing and just continue to either, just be a bad steward, over leveraging, overspending, and not taking control of your finances. So in any event, step one is always going to be to really look at and know your four numbers. Your four numbers are your income, your monthly expenses, your debt monthly payments, and then what's left is your discretionary income or your cash flow. When you complete this audit of yourself, it will allow you to see where you're spending money, and maybe you're overspending in certain areas. Many of us are literally eating our savings. Some of us have 2 or 3 subscriptions and we don't even know it, to different accounts. Some of us are just spending money in places where we are willing and able to cut back so we can create more cash flow, but we just don't see it and realize it. And that's because we've never actually taken an audit of ourselves and our money and how we're spending it. So the practice, just going through the process of itemizing expenses by itself can usually free up between 5 to 10% cash flow. You can request a free 4 numbers workbook from me, and I'm happy to share that with you for free so you can complete your own personal audit. And of course, if you'd like to review that together, you can schedule a one-on-one with me. If you'd like to have coaching, I charge $250 an hour for coaching. I usually give you about an hour and a half to 2 hours with a follow-up if you want one-on-one debt elimination support. Now, we talked about compound cash flow debt elimination. So that's always going to be the foundation, the basis. We're always going to be compounding cash flowing debt elimination, but the next level up is going to be velocity banking. Velocity banking now says, let's continue to do our compound cash flow debt elimination, but let's get our hands on a line of credit, whether it's a personal line of credit, whether it's a business line of credit. It could be a home equity line of credit in the first or second position, but a line of credit is a revolving account that money can go in and money can come out, and we can use it over and over again. The way interest is calculated on a line of credit is based on an average daily balance. Instead of an amortized schedule, it's an average daily balance for the month. So when you use a line of credit and your income and cash flow sits in that line of credit instead of letting it sit in your checking or savings account, because your income and cash flow reduces the balance on that line of credit, you effectively pay less interest on that line of credit. By paying less interest, you increase cash flow, which can then be reallocated to pay off more debt. Thereby, you speed up the process of paying off your debts. This adds velocity to your debt elimination strategy by simply using a line of credit. However, for this strategy to work, you do have to have enough income and cash flow to reduce the average daily balance of your line of credit so that you can realize a cash flow increase, so that will speed up the process. If you don't have enough income and cash flow to reduce your average daily balance, then you're trying to force something that's not there, and you should just stick with your compound cash flow debt elimination strategy. So far we've talked about 2 strategies: compound cash flow debt elimination, velocity banking, and then the third would be infinite velocity, which is using a high cash value life insurance policy with a dividend-paying mutual company where you create your own banking system and you use the cash value portion, which is called paid up additions or PUA, inside of the insurance policy to store your cash. It's going to be growing at around 5 to 6% compounding interest, and this is tax-free growth. You're then able to borrow against, again, the keyword is against, you're able to borrow against your cash value, your savings in your policy, and then put that to work to pay off your debt. Now, why does this add value? Because when you're done paying off the debts, effectively what you're doing is you're transferring the ownership of your debt from the creditor or vendor or bank to your life insurance policy. So then you're going to owe your life insurance policy the same money you would have owed the creditor, the bank, or the vendor. But now you're paying yourself back. And as you pay yourself back, you replenish your policy. So when you're done paying it off, what's left is a life insurance policy that's rich in cash value that will continue to grow in cash value, tax-free for the rest of your life. And with the power of compounding interest working for you, building your cash value year over year over year over year, you can realize 10x growth in your life insurance policy just by saving and storing your money there. And then when you need it as an emergency fund or as an opportunity fund, you can access your money through policy loans, and you can rinse and repeat the strategy of banking through your life insurance policy. So this is infinite velocity. We talked about 3 strategies so far: cash flow debt elimination, velocity banking, and infinite banking. Now, some people should stick with cash flow debt elimination. Stay there, be safe, keep it real simple. Some people have the wherewithal, the discipline, and the ability to manage a line of credit and implement that strategy so that they can speed up the process with velocity. Stay there if that's who you are. And some people have enough cash flow and have enough available liquidity to create a policy, a banking system where they can leverage and borrow against it as part of their velocity banking to pay off the debt even faster, transfer the debt ownership to their insurance, and then pay back the insurance. So they now have a rich asset that will continue to grow for the rest of their life, tax-free. Now, not everybody should be doing the same thing. You have to know yourself. You have to look at your circumstances, because sometimes you might want to do that infinite velocity, but really you need to spend a year or 6 months just doing velocity, just getting the utilization down on your debts, on your credit, getting your freeing up more cash flow so that you can fund a policy. You don't want to put the cart before the horse and fund a policy before you have enough cash flow. You want to make sure you have enough cash flow to keep everything working properly. And there are guidelines that we recommend that you stick with to keep you safe so that you're not over leveraged, because over leveraging is not a good thing. It's like being on the edge of a cliff. If the wind blows, you can literally fall right over the edge. But if you take 10 steps back, you still have a really nice view. But if the wind blows and you fall down, you have enough space to get back up without falling over on the edge of the cliff. Same thing with how you practice your debt elimination with velocity banking and infinite velocity. You don't want to live on the edge. You want to make sure you have a buffer of cash flow availability as well as credit availability in both your line of credit and in your insurance policy. To learn those details and to put together a strategy to look at your boat, which is your business opportunities, assets, and taxes strategy, or your business banking system, whether it's for your business as a business owner or for your personal lifestyle, take advantage of a free consult. I'm happy to talk through that with you. From there, we can schedule a 30 to 60-minute Zoom session where I can show you an illustration of what this looks like for you. This is a no obligation proposition. Please let someone know who will let someone know who will let someone know about this video and this content. I do look forward to speaking with you. Take great care. God bless. See you soon.